Hi guys, today I have with me Shreyans Salecha. He's a good friend of mine whom I met over LinkedIn, and he too has been investing in the markets for past 4 to 5 years. He is an ACCA member currently pursuing CFA, and in this conversation today हमने बहुत ही diverse topics पे बात की, be it equity research, be it mental models, be it portfolio building, and also whether or not professional qualifications like ACCA and CFA help you become a better investor. So I thoroughly enjoyed the conversation. I hope you do as well. So stay tuned. We're going to start right now. Hi everybody. Today I have with me Shreyans Salecha. Thank you for doing this, man. Much appreciated.
Yes.
So I came across your profile when you started putting out these videos. जहाँ पे you did a thorough financial analysis of all these stocks, almost all these stocks in Nifty 50, right? And regularly, daily, you were doing these financial analysis, sharing your spreadsheet and also the analysis, right? So there are two things that I want to ask. First of all, why did you start doing it in the first place? Second, what were the key patterns I'd say you recognized जब आप analyze कर रहे थे, which were common amongst all these awesome companies that are worth investing in?
Right. So, I mean, this slight change. I did not do an in-depth analysis of the 50 companies. I just did an overview and basic financial analysis. And the reason why I did that, the primary reason, actually, there were a couple of reasons. The first reason was that it doesn't make sense to research each company in a lot of detail because we don't have that much time. So I would just do a basic financial analysis of the companies and figure out, okay, at the basic level or at the higher level, it looks okay. Now I can go in depth. So that was the primary reason. And I also wanted to understand and just gather some knowledge and understanding of how the financials of the biggest companies of India work, right? So it was just headline financials. I mean, I took revenue, EBIT, and PAT from the profit and loss statement, the three cash flows, and I took the capital structure primarily, right? Nothing fancy. Calculated few ratios like profit margins, return on capital, then again few ratios for capital structure. So very basic stuff, right? And at least the common things that I noticed or the kind of companies that I like, right? Obviously, there's a bias involved. Was first of all, I saw that the companies that I found doing well were growing, obviously. And there was also an interesting pattern in the growth, that the growth in few companies, at least, not in all companies, but in a lot of the companies which were doing well, was that the growth in PAT was greater than the growth in EBIT. And the growth in EBIT was greater than the growth in revenue. So let's say, for example, revenue was growing around 8 to 10% for 10 years. So the time period for this was 2011 to 2020, right? Headline financials for these 10 years. Right. So the growth of revenue, let's say around 8 to 10%. So EBIT would be somewhere around 12% or 13%. And PAT would be somewhere around 15%. Right. So that was probably the top companies out of the good companies also. Right. So I mean, the companies that weren't doing well weren't growing, or the profits were inconsistent. In the good companies, they were growing, let's say, in some companies they were growing pretty quickly. In some companies they were growing moderately. But in the best companies, the growth in PAT was greater than the growth in EBIT, which was greater than the growth in revenue. So that was one thing. The other thing was the cash conversion was very good, right? So what I did was compare the operating cash flow versus, I mean, you could if based on how you could compare the cash flow before taxes versus the EBIT, or the CFO versus the PAT, right? Just to be consistent, right? So you could compare it for every year, and you could also do a cumulative. So I calculated the total profit for 10 years and the total cash flow for 10 years. So in the good companies, the cumulative cash flow was somewhere between 0.9 to 1.2x, something like that, right? Either it was very close to PAT, or it was exceeding the profit, right? And there was some inconsistency even within good companies on a year-to-year basis, right? Because you can understand how it works, and it also depends a lot on the industry. But on a cumulative basis, they were converting their profits into cash. So those were not just accounting profits; those were cash profits, right? And the third thing was that the capital structure had relatively little debt, right? Now, also one thing here is that, I mean, we'll obviously have to take out the financial companies, right? But among the non-financial companies, in a way that Nifty is also dominated by IT services companies, right, to a certain extent. And because of their business model, they don't need a lot of debt. So obviously, because of how the Nifty is created, and because of the business of the IT services company, you could see that they had relatively little debt. But you would want a company to have, manageable debt, if you want to say. And even in the companies that had debt, the trend was declining, because if you go back 10, 12 years, then a lot of companies did raise debt, right, to grow and to expand, but they were paying off that debt, right? That could be found in a few FMCG companies, that they had little bit of debt, not just within Nifty, but also in some companies outside Nifty, right? So those were the few observations, and the major reason was just to get an idea of, and also to prepare a sort of filter that, okay, I can't go in depth in a lot of companies, so I have this basic exercise that would take somewhere between 15 to 30 minutes, because you can get the data easily, you have the format ready, so the ratios are calculated automatically, so you could just divide this into certain heads. So the things that I would look for is the behavior of the profit margin, right? The growth in revenue, EBIT and PAT, the cash conversion, which is obviously, and another thing was the adequacy of account operating cash flow. So you could do a net cash flow, that is the operating cash flow enough for primarily for investing activities, right? Because the business would want to reinvest. And again, a lot of the good companies consistently paid out dividends. Maybe the dividends might fluctuate, but they would pay out at least some dividends. So the operating cash flow was actually enough to not just invest, but also to pay out dividends, right? And then obviously you would look at the capital structure, and you would break down the ROC into the profit margin and the asset utilization. So those were some observations or some points that I tried to focus on.
I think you've done a really good job in these 3 to 4 minutes explaining कि हर एक financial statement में ढूंढना क्या चाहिए, because ideally profit and loss में margin expansion you would expect, cash
Yeah.
में you would want cash conversion, otherwise there are high chances that the company is doing
Yeah.
something fishy, and debt जितना कम उतना अच्छा. So you've done a very good job explaining, and I'll also make sure that the Excel file that you've made, I'll share a couple of these examples down in the link, so that
Yeah.
people also can see ki how in just, as you
Definitely.
said, 15 to 30 minutes, you just आराम से just easily made out कि ये company research करने लायक है कि नहीं, right?
Yes, that is the primary thing.
Makes sense. Nee, that makes a lot of sense. So,
Yeah.
just following up on this, right? So I'm assuming that you did use Screener as your primary tool here, right? Screener के through ही you
Yes.
were collecting data. So, my question here is कि how do you generate stock ideas? Because I myself love Screener, but then again, investing जितनी quantitative है, उतनी ही qualitative भी है. And when we just rely too much on Screener, I think we are just being very biased towards just the numbers. And as Asudha says, it's both numbers and narratives, right? So I
Yes.
really
Yes.
love that quote. And I just want to understand, besides Screener, how do you think I or anybody can screen ideas when it comes to investing?
Okay, so like for this analysis, I did get all the data from Screener, but I haven't created any filters or screeners. I know you do that very well, but unfortunately, I haven't been able to get into that habit, right? So the thing I've been trying to do a few things with regards to that, right? So the one thing that helps is that my father is also, he invests quite a lot, right? So a lot of times he would just tell me, okay, just look up this company and tell me what do you think about it, right? The other than that, I the way I work is I would follow a lot of investors whose work I found, from which I could learn, right? And a lot of times they share their notes on companies, or they might share ideas. They might not be fund managers per se, but they might just be individual investors who have experience of like 15, 20 years. And a lot of them are very specific on specific industries, right? So that way, because we are starting out, we don't have too much understanding about how different industries work, but because they're experienced, and they also have some sort of educational content, so following experienced investors, and they might talk about different companies, right? Or they might explain different things, so from there you could get a basic idea. The other thing I'm trying to do is that, for example, if we have a conversation, you might have some ideas, I might have some ideas, we could exchange those ideas and individually then work on those ideas. So I'm trying to also find people that are in a similar range of experience that I have, and they could have some ideas, or I could have some ideas, we could exchange ideas and then work on them. And the third thing that I'm trying to do is these are few things I'm trying is to develop relationships with people who are working in different industries. And the primary reason for doing that is the qualitative aspect of business, because let's understand that whatever information that we have is secondary information, it's secondary data, right? None of it has been actually collected by us. And also that data that we have goes through a very specific filter of what to present, what not to present, at least by the companies, right? Even though we have to go with it, we have to trust it, but still that a lot of the data just goes through a sort of a filter process, right? So I'm trying to develop relationships with people who are working in different industries, so they could tell me that, okay, boss, within this industries, these companies are doing well, or this is how, these are the important points in this industry, and the company has to do well on that, right? So basically trying to collect ideas from people. And at least in my experience, I have never run out of ideas. I've run out of time to go in deep. I've to go in depth of different companies, because you could just open the internet and you'd be full of ideas. Or you could just have conversation with 10 people, or even if you organize a small event within 10 to 20 people and ask them to list top ideas, right? You would be flooded with ideas. The important thing here is that the important thing here is actually that you try to interact with people whose investment horizon, let's say, matches yours. So for example, if you are investing for a long term and I'm also investing for long term, then at least we are on the same page at the basic level, right? Because if I want to invest for 5 years, then I can't take ideas from somebody who does intraday trading, right? Because then it would not make any sense for me. So that is the basic thing. But again, the flip side of that is that, let's say you're good at long-term investing. So this is something that I have been trying to learn over the past 6 months, is that I am fairly okay with putting or committing my money for a long period of time after I've done a little bit of research, right? Nothing is perfect, but when I have reasonable understanding, okay, this will work. So I'm okay with investing for, let's say, over 5 years. But I also want to learn that can I make a system in which I can, churn my portfolio for a short period of time. So if I could just buy a stock for 6 months and then sell it, so I could prepare a separate portfolio for that. And if I have to learn that, and I have to obviously interact with somebody. So there are different techniques, right? You have to figure out the technique that works for you, and then you have to filter out the ideas based on the techniques that work for you.
So to sum it up, what मुझे जितना समझ आया, all that you need is a network of really good people, be it your father, be it these fund managers, be it your friends, and just क्या बोलते हैं, curate ideas from them, but then again be very specific as to कहाँ से आप idea ले रहे हो. You're gonna have to be very choosy to separate the noise so that you know what suits you the best. And then again, as you said, कि you also want to go for, let's say, 6 month or 1 year trades, जहाँ पे you're like targeting a very specific niche type of investing. उसके लिए you approach different people, and long-term investing के लिए you have different. So this does make a lot of sense, and I think this is how almost everybody does, even fund managers में. I'm assuming कि investment business maybe they do share a lot of ideas amongst themselves, which is why most of their holdings almost overlap. But
I mean, there are lots of reasons for that. But so I think when we're just starting out, because both of us have been investing for like 2-3 years, maybe 4 years at most, right? So we are also trying to figure out now which approach works best for us, and we are also getting ideas from all the places. We are trying out different styles. I think at the start it is about that. Just we have to be careful that we don't lose a lot of money. Fortunately, that has not happened in the last 1.5 years for anyone. But we just have to be careful that, okay, whatever ideas we are experimenting, we are doing it in a calculated manner. And then over the course of, let's say, few years, we are more or less clear, okay, this is my proper strategy, or this is my bread and butter, and these are the things that I'm trying.
This does make a lot of sense, right? So abhi I'll just move on to a different tangent altogether, right? So although I've been investing and I'm also into finance, right? I have been approached by a lot of people regarding career in finance and investing. And while researching, I realized that you are an ACCA India topper. You've ranked well in couple of papers. So congrats on that. But what I want to understand is, मैं भी ACCA कर रहा हूँ, right? And I want to ask you, So I want to ask you, कि you are an ACCA member. How much do you think your ACCA knowledge has helped you become a better investor? Because ACCA has financial reporting, performance management, finance related. So it is a very diverse course, right? So how has ACCA helped you? And when I ask this, I'm not just asking from a degree perspective कि ACCA का नाम जुड़ गया अब श्रेयांश के साथ and he's become a member, so he's sort of looked up to. But then again, how has the knowledge really helped you?
Yes. I did not know you were doing ACCA. If you need any help, let me know. है ना? And but okay, now the thing is that so of course there's a lot of variety. I mean, in any professional accounting course, be it CA, ACCA, or CPA, right? So the thing that there is that you have to go through a lot of subjects like accounting, tax, law, audit, finance, costing. All of these subjects are there, right? So obviously you get an understanding. Now I wasn't that good in accounting back in school, right? But then you would obviously understand that the way we are taught in school and what we are taught in courses is, I mean, I don't know, I don't see the too much similarity there. You study as per the standards, which is good. And what really helped me actually was that I also used to teach a few ACCA subjects. So I've taught financial reporting, I've taught performance management. So that really helped me to understand it from a broader perspective. Now, when it comes to investing, now from the technical skill part of it, it obviously helps here. I mean, if you pick up somebody who understands how to code, I mean, they would obviously build a better app, right? Or if you pick up somebody who doesn't have that skill, they will take that time. So in investing, you have to have at least a basic understanding of the numbers. Right now, the thing is that what any sort of professional training does that it also helps you to go in depth with the numbers, right? So now for some, let's say somebody who understands accounting but doesn't have too much experience, let's say somebody, a friend of ours who belongs to a different stream, and they have basic understanding of accounting, so they'd be able to understand at that level. But the way you and I study accounting, we know how to manipulate different numbers and to calculate different metrics, which are not always available on the financial statements. We know how to read the notes to accounts, which are very important, right? So it obviously helps you to go in depth, and obviously the more the deeper that you go, the better you will be able to understand. So from a technical perspective, I think it has definitely helped. Now the way that it's the place where it stops helping is understanding the business, to be honest, right? Because it obviously helps with the quantitative aspect of it, but I don't think that any qualification can honestly help you with regards to understanding the qualitative aspects of business. Of course, there are models, and there are different matrices that you have. For example, you have a BCG matrix, you have an Anson's growth matrix, and all of that stuff. Or there are a lot of principles by McKinsey. There is value chain and all of that stuff. But you still have to understand. I mean, you still have to read about the business to understand the business. You could have these frameworks. So from a, let's say, from a quantitative perspective, professional training, or professional education, not training but professional education, is very helpful, because it can really help you grind down. It can, like what we call diligence or due diligence, the process that we call it. So it could really help you with respect to that. But with respect to the qualitative aspect, I think experience beats most of whatever we are taught. And from the psychological perspective, I think again experience reigns supreme over most of education. So it is a very good way to start, because you can't start with the qualitative aspect very soon, or you can't start with the mindset or the psychology aspect of it. Ideally, you should be able to do that, but unfortunately, because it's very vague or it's very subjective, so because numbers are objective, you can start very easily there. But then when you have to move, or you have to go further in your process, then you have to have your experience. You have to put in the hours and work for it. So definitely with numbers, with quantity, with going in depth to the financials, ACCA and obviously CFA, whatever little I've studied, it really helps. But after that, you have to sort of learn from other places as well.
Makes sense. So, like, correct me if I'm wrong. What I could make out of it is कि you're saying all of these professional degrees, चाहे कोई भी हो, it helps you lay a very strong foundation. But then again, that not is enough for you to just go up the top. That will be supplemented by, let's say, experience
Because
हो गया.
you would be surprised to know that, but I know a lot of people who are very good professionals, right? Or who have got very good professional education in the field of accounting and finance, but they don't even invest,
Totally
right?
agree.
So right, so it will give you all the knowledge or all the tools, but you have to apply it. And it is not as if that they don't invest, they are actually confused about how to invest. They have studied it, right? But they're still confused about, oh, how do I research this company, right? And it's sometimes it baffles me because we've literally studied that. And I'm not even talking about just freshers. I'm talking about experienced people, right? I'm talking about people who are like 5, 6, 7 years older to us, and right, their experience, they have qualification, they have experience, but still they face problems with respect to investing, or still they're confused about how to do it. So obviously it sets the foundation, but then we have to apply it. And so having that professional qualification is good, but if you don't apply, it's useless.
Nee, I totally agree with you. And this is something that I've also experienced, right? And I think the only way around is whenever you're studying this, do not study for the sake of it, but solely to just get better at investing. So I'll tell you, I recently gave my FR, financial reporting exam. For all those of
Okay.
you who don't know FR is proper corporate accounting. जो भी सारे company accounts आपको दिखेंगे, all of that हमें सिखाते हैं. So the only reason I really loved that subject was because I knew कि जो भी मैं सीख रहा हूँ, I know कल को अगर मैं annual report पढ़ूंगा, उससे मैं investing में better हो सकूंगा. And that was my mindset, and I think that really helped me uh, क्या बोलते gauge more interest in the subject and at the same time become better at investing. So a good, I won't say a recommendation from me, I'm still a noob, but then again, this is what I learned and I hope you guys also apply. So apna Shreyans, we'll move on next aage, right? And you've talked about different sectors. Now there are a lot of sectors out there, and I know for a fact you literally can't just be master at all. So there might be few sectors जिसमें आपको या तो either you have a good knowledge or you have certain biases because you have some internal information, or they just simply interest you. Which are these sectors according to you, which you feel comfortable with and you are like कि हाँ ये मेरे best sectors हैं? And why do you think that happened? Was there a specific approach that you had while addressing those sectors, or just help me through it?
Okay, so I have slightly different approach, right? Because let's say there's a, you would have also heard of it. There's a top-down approach. There's a bottom-up approach, right? Economy, industry, and company, and then from bottom up, you start with the company. Now, obviously, both are useful in their own places. The way I actually started is that I would pick up a company that would interest me somehow, right? It could be a company that I like, whose products I use very frequently, a company which is in the news, it is trying to do something innovative. And this is something I try to recommend to people who are starting out as well, because let's try to talk majorly to the people who are starting out, because we can help them the best. We can't help people who are experienced, right? But then, so I feel that this is something I recommend to a lot of people, right? That start with a company that you are interested in, right? Because curiosity helps at the beginning, because it is not a straightforward process. Researching a company is not a straightforward process. And a lot of times you just have no idea what to do. So at least if you have curiosity about the company, you will have that spirit to go through the whole process. Especially when you start, you have to put in a lot of hours just to understand the basics. So in that case, having the curiosity or having an interest in the company really helps. So just pick up a company that you want to study, right? And the best way, at least I found, to understand different industries is also to pick up a company in that industry. You could pick up one of the top two companies or one of the top few companies, or you could also pick up a company that is trying to create a new industry, right? Because, and then what you could do is that once you're starting to understand how this company is performing, and then you can contextualize it with whatever is important in the industry, right? Or you could find some resources on the industry to understand it. Because let's say, even if you're trying to understand any industry just from a, from an industry perspective, let's say your goal is to understand the industry itself, right? Sometimes it could become pointless. Like, you would not really understand that, okay, what am I doing, why am I understanding so much? But when you see a company performing a specific way in a given industry, then you have better context to understand that, okay, these are the given risks in the industry, these are the given opportunities. So the way that I started was, I just picked up a company, and in fact I picked up in a company in an industry that I knew nothing about, right? So the first company that I probably did a proper research was Syngene, which is a, it is a very niche company. It's a very niche business. It's a scientific, then it's in pharma, it also makes chemicals. At least at that time, it was putting up its infrastructure to produce chemicals, and I knew nothing about. I literally had zero idea what the company did, right? And I just picked up this company by chance. So I understood the financials, and then thankfully I found very good resources to understand that how this industry works. I found some webinars, I found some articles, and then I was able to understand that, okay, what is the process of making a drug, or what is the process of, like how long is the process. So I think, and obviously the best way to understand an industry is to work on it, but we can't do that, right? So our knowledge or our level of understanding has its limitation. But if you pick a company you're interested in, it doesn't matter which industry. I just ask people that if you're starting out, stay away from financials, stay away from any sort of financials company, whether it is a bank or an NBFC, or even if it's an insurance company, it is off the charts, because the business is quite complicated. At least in the details, it's very complicated, right? So pick up any company, any sector that interests you, try to understand the company, and pick up different companies from different sectors. Because look, I don't think that in the starting 2 3 5 years anybody could say that, okay, I understand the sector very well. It is very difficult, unless and until you just research only one sector. You have to research different sectors to figure out that, okay, this sector I have an intuitive understanding of. This sector, or this sector has these characteristics. Like, most of us understand that IT services as a sector produces a lot of cash flow. It doesn't need a lot of external capital, right? We understand that within FMCG, distribution matters a lot, right? Branding matters a lot, because the product cost is, I mean, it's not very significant per se, right? Or within the banking industry, or underwriting standards matter a lot. So as you understand different companies, you would be able to understand industries, and then you could understand that what sort of industry characteristics are you okay playing with, right? Because certain industries have certain characteristics. Now you can't change the industry, right? But you have certain expectations.
Can you elaborate on this key certain
Ha,
characteristics of what do you mean by this?
certain, right. So for example, let's say if you are, let's say, a construction company, right? Let's say you build buildings, and you rent out buildings to people or whatever. Right? The operating cycle will be very long, right? And because the industry is capital intensive, that, and the cash flow cycles are very, these are very long, so you would require external capital by default. I don't think it is possible to do some sort of construction business without having external capital, right? And then on the other hand, let's say for example you have an IT services business. You understand that, okay, they will be producing a lot of cash, right? But they don't need to, invest too much into infrastructure. They primarily need to invest in their employees, the training of the employees, because they are the ones delivering whatever service that they're providing, right? So you understand that employees are a critical aspect of that industry. And because they have limited opportunities to reinvest, because the money that we pay to employees is a yearly cost. You don't have to like put anything up front. So they would have very limited opportunities to reinvest their capital. So they would be paying out few dividends, right? Then let's say FMCG. Now FMCG, we all of us use products on a daily basis, right? But you would find that, it is difficult to consistently make double-digit margins in FMCG, right? Because the landscape is very competitive. There are a lot of local companies, there are a lot of regional companies, right? You have to spend heavily on branding and marketing, right? But you understand that, no, the conversion cycle is very quick, right? So there are different aspects of different industries. Within the pharma industry, the gestation period of any new drug is very long, and it is front loaded. You have to spend a lot of money at the start, and you get the returns later, right? So if you're investing in a pharma company, your time period has to be by default a long time period. You have to be stay there for like 5 7 10 years by default. Otherwise, if you're investing into a company which is it's in its investment phase, let's say it's investing in a new drug, or it's investing in new facilities. Like for example, I was researching Syngene. Now I know if I have to invest in Syngene, because the process on that industry takes that long, I have to hold it for at least this long for me to see any significant impact in the business per se.
This does make a lot of sense. So if I was to sum it up, you're basically saying each of these sectors will have certain characteristics in terms of expectations that we can have. Uh, Construction and realty will have a lot of debt. You're going to have to be comfortable with debt if you want to invest in this sector. As you said, IT stock may it will be a lot of free cash flow, not a lot of reinvestment opportunities. Same goes for, let's say, an FMCG. Margins will be thin, but then the company will have to play on turnover or volume and scale. So
Yes,
these are few
yes.
themes that you must associate with these sectors. And once you understand them well enough, you're gonna have to be comfortable. Only then, and same goes for pharma. And I think that does make a lot of sense when you're approaching sector-wise investing, so that you yourself find a niche and something that you're comfortable with. So ये तो हो गया. Now we'll come to the more important question, wherein you said company, right? So company ki proper equity research, right? And you said ki it's a very complex process. It's different from one, and there are a lot of uncertain whatnot. I just want you to simplify all of this process in few simple steps that we can follow. Not as comprehensive per se, but just give me a framework so that I have in mind whenever I'm approaching equity research of the whole company.
Okay, so the first thing is that if you're starting out as an analyst, let's say, right? Because let's say you are also very interested in stocks, even if you don't pursue a job as an analyst, right? So for somebody who really wants to get into it, spend a lot of hours at the start, right? So at least at the start, go really in depth of a company. Like I spent like almost a month and a half on just one company, because then because you could always cut out the details later. But if you don't go into the details first, you'll never know what to do and what not to do, right? So that is one sort of asterisk point, if you could say it like that. But now coming to the process, I'm also trying to build a process and obviously continuously try to edit it. The first thing is, obviously, we talked about the sort of filter, right? So the filter that we talked about was just do a headline financial analysis and understand that, okay, what is happening, right? So and that will give you an idea whether you want to go in depth in the company or not. Like this would work in most cases. Obviously it will not work in all types of companies. Let's say a turnaround company, you will not find this very useful, right? But it will work in a lot of companies, at least. That's how I have experienced it, right? So basic, you decide whether you want to go ahead to the detailed research or not. Then I like browsing through the company's website just to get an idea, feel of what the different products the company sells, what are the different services, right? Sometimes they have really brilliant websites and they communicate very clearly, like these are the products, these are the services, right? And these are our brands, these are our milestones, or this is how we've expanded. And sometimes, obviously, in case of few companies, they have sort of very specific products. Like chemical companies, the product names would be slightly technical per se, right? But the reason is going to the website just to have an understanding, because we have to understand that whatever annual reports or investor presentations, they are made for investors, but company website is sort of made for the general public, right? And also for customers as well, right? Because a lot of customers would, I mean, in a lot of businesses, they would go to the website to understand, or it is sort of a digital presence for different companies. So basic financial analysis, having a sort of feel of the company going through its website, right? Then I used to start with the financials. So the 10-year you have overview financials, for 5 years you have sort of detailed financials. And detailed financials as in full financial statements except the notes to accounts. I would move on to specific notes to accounts if I feel that it is important or it is significant with respect to that company, right? So then, and you would do a basic analysis there, like a comparative statement, a common size statement, or a ratio analysis, right? So these are the few things that you would be able to do. Analyzing different segments, I feel, is very, very important, right? Especially in a company that has different segments. I think that is important. But basic finances, then you understand the basic business or products of the company, then you go in slightly in depth into the financials. And by slightly in depth, I just mean the full financial statements that are there in the annual report, right? And you do a comparative, a common size, and ratio analysis. After that, you write down your observations. This is something that I have practiced. I understand, okay, so observation simply means that revenue has grown by this percentage, or revenue has doubled or tripled or whatever. Similarly, for different sorts of financial statement items, right? For balance sheet, income statement, and cash flow, right? So this gives you at this point, we are trying to understand what is happening, right? Now we know, okay, this is happening in the company. And similarly, if you want to understand the business model of the company in a similar way, in a simple way, sorry, not a similar way, but in a simple way, each company has a product or service to sell, right? They all sell it to some customers, right? And they all need certain resources in order to provide that product or service, in order to manufacture that product, in order to provide that service. Now within this whole structure, there are some inherent risks, right? There are some regulations that the company has to follow. So you try to break down the business model into as simple terms as you could, right? That these are the products and services, these are its customers, this is how the company sells these products and services to these customers, and these are the resources that are very important for the company in order to manufacture those goods or in order to provide these services. It could be anything. It could be infrastructure, it could be a proprietary formula, it could be quality of employees, or it could be whatever, right? And now within this framework, these are the challenges. I think understanding the risks of the business is probably a very important point for most people. And in a lot of annual reports, they have actually given these risks as well. They explain, the companies detail out the risk, that there will be few generic risks like liquidity risk, or capital structure risk, or revenue risk, or things like that. But there will be few company specific or industry specific risks as well. But okay, coming back, basic financial analysis, basic understanding of the business, uh, sort of slightly deeper analysis of financial statements, slightly deeper, or slightly, sorry, more simplified comments about how the business works, and observations about the financial performance. So after the, let's say, the first step, you have observations about the financials, and you have a simplified understanding of how the business works. Right now, your job is to understand the business in more detail, right? I like revenue has grown by this percentage, and now you try to understand how has the revenue grown, right? By what has the company done in order to expand its revenue. So at this point, you start going into the annual report. You start with the management discussion and analysis. I think that is probably a management discussion and analysis, and to a certain extent, director's report. But director's report doesn't give you any analysis. They just state, okay, what has been, what has happened, or what are they planning to do, right? But the management discussion and the analysis, they'll start with an overview of the industry. They'll give an overview of the performance, and they'll probably sometimes write about what they plan to do in the future, right? But we should be very careful while reading anything that has been communicated by the company, because it is very polished. It is very, very, it's been spoken in a very elegant way, in a very rosy way, or whatever, right? So, but you still need to go through it, because that is the primary source of information that you have, at least at the start, right? So you read through the management discussion and analysis, and obviously you have to go deeper into the notes to accounts as well, right? So next, what I'm trying to do is I'm trying to go deep both into the business as well as in the financials, right? So now at this point, with respect to financials, I'll probably, try to understand the trend of capital structure. I'll try to calculate free cash flow. I try to calculate what is the cash and debt position. I try to do an analysis of revenue by different ways, probably by segments, probably by geographies, probably by different things. So a lot of times this information will be available in financial statements. A lot of times you'll have to, do some, take some information from here, some from there, and then try to do that, right? So now I'm trying to understand that how is the business driving the financial performance, right? And one very important exercise that I'm also trying to get into the habit of is, reading a lot of quarterly con calls. I think those are, they provide more information than, let's say, the annual report or the investor presentation. They, the purpose of investor presentation that I find is that the investor presentation tells you what's important in the company, right? I mean, so the metrics that they're presenting, so that metrics is important. I am not concerned with the performance of that metric. I'll evaluate it separately myself. I'm not looking at the analysis or the information that is being provided in the investor presentation. I'm just looking at what is important, right? And then I'll evaluate it separately. Throughout the entire process, one thing is very important, is the documentation. So initially what I'm documenting is, at the basic financial analysis, I have probably like 6 to 8 lines, right? This is the profit growth, this is the revenue growth, this is the margins, this is the turnover, this is the capital structure, this is the cash conversion, right? Then I have calculated the ratios, comparative common size. Then I have written down the observations. Okay, this is how different items in the financial statements are behaving. So that is my second thing that I've documented. The third thing I've documented is the simplified version of the business model, right? After that, I've calculated few quantitative metrics, financial metrics or non-financial metrics, and I have tried to document the environment of the business, right? Which is, in some aspects, you could have industry related points, you could have customer related points, or any points that are relevant to the business that I feel are significant, right? And obviously there's a lot of judgment about what's significant and what's not significant, but that is something that you can only learn from experience, right? And so this is more or less the process that I'm trying to follow. You obviously read through the annual report, the investor presentation, and the conference call, right? Some companies don't do con calls, right? So I mean, slightly unfortunate, but this is sort of the process that you can follow. At last, you can do valuations as well, but then valuations is an extremely subjective issue, right? I mean, we can learn different ways of valuing. You could learn cash, you could learn DCF, you could learn relative valuation, but I mean, it's slightly challenging. And I mean, obviously, the more you do it, the better you will get at it. But the one interesting thing that I have learned to do is I download the entire stock price history of a stock, right? For some companies have been listed for over 20 years, or I mean, you've tried to find the oldest data that you can. You could use Yahoo Finance, you can use Google Finance, you could just use Google Sheets and Google Finance ka formula, and you download the historical price data. After that, you can calculate certain metrics, that what is the 1 year rolling return, the 3 year rolling return, or 5 year rolling return, because I feel that gives me an idea of how the company's stock has performed, right? Over different time periods, 1 year, 3 year, 5 year, 7 year. I'm not calculating with specific dates, I'm calculating rolling returns. This is an important point here. And then I can calculate the median rolling return for 1 year, for 3 year, for 5 year. And here, another thing I could do is I could formulate a strategy. For a simple example is, let's say that I have 20 years of data, right? So I have a large number of 1 year periods, a large number of 3 year periods, but also significantly large number of 10 and 15 year periods, right? I mean, I have a decent enough sample or a decent enough population. Now I could formulate a strategy that buy this stock whenever the price falls by 2% or more, right? So then I can filter that on which days has the price fallen 2%. And I could create a hypothetical portfolio that whenever the stock price falls more than 2%, I buy this, or I buy either 5 shares, or I invest a specific amount, right? And then I could calculate the return of that portfolio, right? So that sort of gives me more perspective of how to, time my entry into the stocks rather than valuing as well. Because I mean, valuation is a very complex exercise, right? I mean, there are endless ways to do it. There are people who teach valuation very beautifully, right? And despite that, valuation remains a challenge. So I'm not saying that don't do valuation. Obviously do valuation, learn valuation. It's very helpful. It provides a lot of context. But other than that, you could also try to formulate strategies around entry and exit, because when we are not experienced, we need sort of simpler things to work on, right? Now I don't understand the logic that if I'm investing whenever the stock is down 2% and it is given me this percent CGR, I don't know how this has happened, to be honest. But if I value it, I know how it is happening. But at the start, it is a very complicated process to get valuations accurately, right? So you need a simpler process as well while you learn the more polished version of it, let's say.
This
So that is that.
Thank you so much for a very comprehensive, I'd say, way that you've explained it. And I totally agree with you that it's an like it's an ever evolving process. I'm pretty sure you yourself never just woke up one day and like ki हाँ मैं ये करूँगा. This whole
You
list
have
that
no
you
idea.
prepared, वही, it does
Nobody
take a
knows
lot
how
of.
to start.
Exactly. But I think this is a good starting point, and then I'd like my audience to, like even I myself follow a lot of things. What you've said, some of you things differ, some I do not. I will start following from now on, and I think that is what makes investing a very dynamic process itself. Because when you learn from a lot of people, you can take the best out of those and just sort of make your process the best out of
Right.
everything. And this is just awesome, especially when you're investing. Something very unique that I look up to and something I admire about investing. But okay, now I'll just not take much of your time. Just last question, right? Portfolio की बात की, portfolio level पे. We've talked about companies, we've talked about equity research process, but what matters is कि our portfolio is doing well. The only reason why we're in the अपना market is we learn a lot, all of that stuff, but पैसा कमाना है. So portfolio level पे, there are a couple of things that I want to know. First, diversification. How do you intend to diversify, and what is the ideal portfolio size according to you? How do you think कि इतने ज्यादा अगर stocks ले लिए, maybe I'm diversifying too much, or अगर कम है तो maybe I'm concentrating a lot. So how do you approach that, and how do you ensure कि आपके portfolio में there is enough diversification?
Okay, so I have a slightly different approach to portfolio, and for somebody who's just starting investing, I'll never recommend you to start with stocks, right? So a lot of people directly jump into stocks. I would not really recommend that, right? It doesn't matter how smart you are. It doesn't matter if you belong to an accounting or finance profession. I follow a sort of a simple approach that I want to have a foundation of safety, and then I want to go for returns, right? And I'll just explain that very quickly. Is that now most people understand the concept that if you want safety, then your returns will be low, right? And if you want, if you want higher returns, then you have to go with low safety. This is the traditional way to think about it. right? Now you could argue that this is not the good way to think about it or whatever. I'm not interested in that. What am I interested in is making money and being safe at the same time. So the first thing is you start with safer instruments, right? Now, in this day and age, everybody gets criticized for fixed deposits a lot, right? But if you go back 10 years, then our parents made considerable amount of money using fixed deposits as well, because they provided that sort of return with the safety as well, right? You have to find some options that keep your money safe, because that is the first priority. You cannot afford to lose money, especially when you're starting out, right? So for example, liquid funds are a good alternative, and arbitrage funds are also good alternatives. So I would say start with safety, right? And you could calculate, like a lot of people have this concept of emergency fund, right? So emergency fund is also a good way to start, because technically you're not going to keep that money like in a emergency box per se. You're still going to invest that money somewhere, maybe in liquid fund, maybe in savings account, maybe even in fixed deposits. Look, you have to be comfortable wherever your money is, right? It might provide high returns, it might provide low returns. You should understand what is happening, and you should be okay with it, right? So start with safer instruments. Now I would say that when you're starting out, your proportion of investing in safer instruments has to be higher, right? So in the first 1 year, you probably want to invest largely in safe instruments, right? And you want to build a safety corpus of, let's say, 2 to 3 years of requirement, right? So for example, if I require this much money for 2 or 3 years, this is my monthly expenses, or this is my monthly income. Based on that, you could calculate that, okay, this much amount of money I need to be I need to have absolutely safe, right? And you have to be careful, their return doesn't matter, right? Because a lot of people want, yeah, what happens, especially in debt, what happens is that in order to go from 4% return to 6% return, you might be taking a lot of risk, right? Especially within debt. So when you're investing for safety, safety is your primary concern, right? Your primary concern is not returns. For that, we have equity. We will make money by investing in equity, but at the start, safety is paramount, right? So now every person has to figure out for themselves that how much safety do you need, right? Because it also depends a lot on your financial commitments. It depends a lot of how much money you receive from your family, how much money you contribute to your family's financial conditions, what sort of insurance do you have, or I mean a lot of different factors that we have in financial planning. But start with safe options. So let's say you start with liquid funds, okay, and you keep depositing money in liquid funds. Then you slowly move on to index funds. Right, index funds are absolutely beautiful products for a lot of people who don't want to go through a lot of the hassle, right? After index funds, you could move into, let's say, mutual funds. We actively manage mutual funds. Sorry. And a lot of people skip that as well. I mean, that is up to them, right? But sometimes you will find good mutual fund products as well. It's not as if the all mutual fund products are bad, or all mutual, they serve a specific purpose because it reduces the amount of effort that you have to put, right? And so basically in the initial 6 months, let's say, higher allocation to liquid funds. In the next 6 months, let's say, still significant allocation to liquid funds, but you've started investing more in index funds. In the next 6 months, right? Let's assume that you have reached the amount of safety that you require. You have reached the level of safety that you require. Now you're investing majorly in index funds, little bit in liquid funds, and little bit in equity funds. In the next 6 months, you're investing primarily 50% in index funds, 50% in equity funds, right? So, and whatever SIPs you have, right? Like whatever SIPs of index funds or even mutual funds, keep that going, right? Don't stop your SIPs just for stocks, right? So, and what also happens that, let's say, I have mentioned 4 6 month periods. So it's almost 2 years. Now, within those 2 years, you can understand a lot about how companies work. You can still build a relevant skill set, and you could still build that mindset, right? Because you could still build skills in, let's say, 3 months or 6 months, right? If you pay little bit of you, if you put in that amount of effort. But building a mindset, or building the right psychology, or understanding yourself that what sort of investing style suits me, building that gut to take corrections in your path, right? Because this is what happened in March 2019, right? Sharply, the portfolio fell 30, 35%, 40%, right? The market fell around 35, 40%, and portfolios would be north or south of that, right? So you have to develop that experience of also taking that punches. right? Because if you go directly into stocks, you might not be prepared. But because you have this 2 years ka experience, you have saved those 2 years ka money. So if you're consistently investing for 2 years, then you have a sizable portfolio, right? At least for a beginner. Even if you're investing 10,000 rupees a month, that means you've invested 2,40,000. And the value of that might be somewhere near 3 lakhs, near 3,20,000, or it might be also be around 1,80,000 if the market is bad or if the timing is bad, but you still have that money, right? You have the foundation of safety, you have the money, you have the experience, and hopefully you're also developing the right mindset. Then you can move into stocks. And because I've developed that safety initially, then I don't need to worry so much about your debt ka allocation kitna hai, equity ka allocation kitna hai. It's very simple. Whatever money you want, say, prioritize that. And then whatever money you could afford to lose, you could invest that in equity. Now, maybe it is a bit naive of me to suggest this process, but I think this would work well for at least the initial 2 to 5 years, right? Because let's assume you get out of college at 20 to 23, or in these days, people start earning at 18, 19, and whatnot, right? I mean, as early as they possibly can. But let's, for the sake of discussion and for, conservative estimate, let's say you start earning at 21, right? So for the 2 to 5 years, you're also figuring out your career, you're also building, you're also involved in a lot of things, you're spending, I mean, you're enjoying life as well. So within those 4 to 5 years, you lay the foundation, because investing is not a 5 year game. Investing is a 50-year game, right? So you could afford to spend those initial 4 to 5 years laying down the foundation of the habits, right? Because like having an SIP is also a habit. I mean, if you ask people that you have to invest manually every month, they might forget that. They might not have that discipline. So you build good habits, you build a decent portfolio, you build experience, right? And after 25, after 26, after 27, life starts changing as well, right? Because you start having more responsibility and you start moving, you start focusing more, or you have a focused direction for your career, right? So at that point, you might want to, follow a goal based approach, right? Because like goal based investing is also very helpful. But I don't know how to define my goals in the initial 2 to 5 years, right? I don't even know what are my absolute career goals. Like, how do I define my monetary goals? Obviously, okay, you might have some goals. I want to buy an iPad, or I want to buy this, and for that you could invest separately, or you could follow a separate approach, right? But initially 4 to 5 years, I don't have too many goals. I'm still learning, I'm still figuring stuff out, right? So start with safety, slowly build up, and then as things keep changing, you might want to switch it up, right? So after those 2 years, you could invest primarily in equity or stocks, right? You understand how it is going. Then you could invest in gold, then you could invest in crypto, you could invest in whatever you want, right? The important thing is that you should be okay with wherever your money is, right? I'm not saying you'll be happy all the time, but at least you should be okay with it. And I mean, you should not have, let's say, anxiety because of where your money is, because that is a very big red flag, right? And I think because a lot of people, it is not very intuitive to have a long term mindset, right? So if you sort of go through this process of first keeping your money safe, then investing in instruments that offer decent returns, but you don't have to do a lot of effort, right? And continuing those SIPs all the time, and then getting into stocks, right? So it sort of prepares you step by step, right? At least this has helped me, and I feel this is a slightly, it takes little bit of time, right? It takes sort of the excitement out of the process, it takes the fanciness out of the process. It's sort of very simple, you don't have to do too much, right? I mean, you have to do a lot of money, but it's not like you're making money every day. It's a sort of a boring process, sort of a long term process, but I think it will lay a very good foundation for long term. And I don't know how to manage our portfolio after we are 20, after we are 27 or 28, or let's say after we are married. I don't know how to manage our portfolio. I could only tell you that when you start investing for the next 5 years, this is how you could build your portfolio. And if you have the right habits, then I think after 5 to 6 years of experience, if you could have a good financial advisor, or even by yourself, you would at least have a decent idea. So this is sort of my approach, instead of going the traditional way of 20% here, because like there's a very common formula as well, na, that 100 minus your age should be in equity and the remaining should be in debt. I mean, okay, these are, sort of, these are good indicators, right? Or you have 50, you have financial planning, you have 50, 30, 20 rule, or you have all sorts of different rules. I think those rules are helpful in their own way, but I am more interested in, aligning my thought process with my investment, or aligning my mindset with my investments, right? And I am not a risk taker by any stretch of the imagination, right? So for me to invest heavily in equity is sort of counterintuitive, But in order to make that easy, I have already invested that money in debt. So now I'm safe. I've taken care of my safety. Now I'm slightly okay with taking risk. As I get more experience, as I get more money, right? As my understanding improves, then then my risk taking ability also improves. And then I could also have specific goals, right? So this is my approach that I've been following for portfolio building.
I think you've answered it way better than I expected, because the answer that I expected was a traditional answer, asset allocation kaise karni hai. But then again, you've touched fixed deposits, debt, index fund, mutual fund, stock, and जब ये भी discuss किया when not to sell, when to sell, what could be possible mistakes. So the whole portfolio level पे you've given me a good idea of how your investing journey has been for 3 to 4 5 years, and I personally have learned a lot. So I think it was a pretty good session. I thank you. I really thank you a lot for this conversation. Now I give you the opportunity to tell the audience, in case they want to learn more about you, where can they find you? All your social media handle. It's all up.
I'm not very active, right? If you want to reach out to me, just send a message to Kashish. Hopefully, he'll redirect you to me, right? Unfortunately, I've not been very active on YouTube or Twitter or whatever, right? But you could find me very easily on different social media platforms, or just drop a comment below. I'll reply to that comment, right? And so, yeah, that is it. If you have any questions, then please comment, or you could reach out to me directly as well. I'm obviously very approachable, right? We're just young people who are trying to learn, both of us. So both of us are very approachable. Just send us whatever questions that you have. We'd be able to talk, and that is how it is. But if you want to reach out to me, either message Kashish, drop a comment below, or I could be found very easily. So nothing
Absolute.
like that.
So also one more thing, Shreyans also has his YouTube channel wherein he has uploaded a very comprehensive playlist of an equity research process, जहाँ पे financial analysis की he has a playlist along with a couple of videos on forensic analysis. So I'll make sure I'll put क्या बोलते हैं, links to all of those videos in the description in case you want to learn more about him or his videos. Again, thank you so much, audience and Shreyans,
And
for
hopefully, after watching your videos, I'll be motivated to make more videos, because I sort of left that in between. But hopefully, after watching your work, I'll be also, more encouraged to put out my work. So, it
definitely,
was very interesting to have this conversation. We haven't had the time to catch up, and this was a very good way to catch up as well. And let's see how it goes. Thank you
definitely.
so much.
Thank you so much. Bye.